Please stand by. We're about to begin. Good day, and welcome to today's Softrax Executive Webcast. Just as a reminder, today's call is being recorded for future playback. I would now like to turn the conference over to Mr. Bob O'Connor, President and CEO of Softrax Corporation. Please go ahead, sir.
Thank you, Anthony. Softrax is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today. We have over 1,000 registrants for this webcast, which indicates how much executives want to hear about today's topic from our two distinguished speakers. They are Lynne Triplett and Jacqueline Akerblom of Thornton, who will make their presentation entitled Laying the Groundwork for Accurate Revenue Recognition. Both Lynne and Jacqueline will be available for questions at the conclusion of their prepared remarks. Jacqueline joins us from California, Lynne from Chicago. I'm in Virginia visiting customers, so we have the country covered today. And our audience consists of CEOs, CFOs, board members, venture capitalists, VPs, accountants, and other corporate professionals and financial professionals. Let me just take you through the agenda quickly. I'll just spend a few minutes on Softrax and revenue management and how it ties into today's topic, and then we'll turn the proceedings over to Jacqueline and Lynne, who will share their presentation for the majority of the program. For those of you who are unfamiliar with our webcast format, we do leave about 10 minutes at the end of the program for you to ask questions. And this entire program will be done by the top of the hour. Now, to ask a question, look for your Ask a Question box on your console. And if you click on that and then type the question, I will be reading your questions throughout Lynne and Jacqueline's presentation. And the most commonly asked question is, can I get a copy of the slides? And usually we make you work for that and ask you to complete a questionnaire. But if you look now, you'll see that the questions can be accessed now at the bottom of the console if you wanted to print them off now and follow along. Otherwise, and no matter what, we want your feedback. We listen to your feedback carefully, and this webcast is evidence of that, as people do continue to want to talk about revenue recognition issues. So upon conclusion of our webcast, your browser will be automatically redirected to an online survey. We appreciate that survey, and you'll get slides then if you haven't gotten them before, and you also get a link to an on-demand recording if you wanted to listen to the recording again or share it with a friend. So that concludes, from a housekeeping perspective, what we'll do. And please remember that we do want your questions, and I'll be reading them throughout the presentation. Just a few minutes on Softrax and how we fit into this. Our company develops enterprise software that manages all aspects of a company's revenue lifecycle. And throughout the U.S. and world, hundreds of companies from many different industries use our software to manage their revenue, their billing, revenue recognition, reporting, and forecast. And as you may know, Softrax started by serving the complex revenue needs exclusively of software companies, and we are the clear leader in that market. And as you can see from the slide, we have grown to address the complex revenue needs of many other industries. In a recent study by IDC and RevenueRecognition.com, it was found that the great majority of companies still are using spreadsheets to manage critical revenue recognition activities. And this is a source we see material weaknesses in their operations. And as the regulation pressure continues to rise, you'll see that just as a result of Sarbanes-Oxley alone, more than half of the public companies and almost half of the private companies have changed their revenue recognition policies. And CFOs and other executives do not lack for challenges in today's environment. They have operational challenges related to their business models. Many people that we deal with have a multitude of business models that need to manage their contracts with their customers, whether they have a recurring model such as a on-demand model or a subscription or transaction-based, whether they're managing licenses and maintenance contracts. They also have many issues that Lynne and Jacqueline will talk about today, obviously in terms of revenue recognition and compliance. And also they have financial reporting and visibility challenges. And our solutions closely match and are closely aligned with these challenges for our customers. Our solutions are focused on billing and operational efficiencies, managing complex revenue and expense accounting to make sure that people are compliant, and lastly, to enhance their performance and visibility to make the correct strategic decisions. And at a more detailed level, our applications are grouped along these lines and are focused on managing the contracts with customers, renewals, complex billing, very deep and unparalleled revenue recognition capability, and strategic applications that provide insight into better decision-making. And these applications can be licensed as a suite or one application, depending upon the needs of the company and existing infrastructure. And they may or may not be complemented by other applications within our suite. And all this unique functionality is provided really into two major offerings, complete billing and revenue management solutions that's really industry-specific, whether companies are software companies or software as a service or business services, and you can see from the slides, internet companies and so forth, really very unique specialty applications for those industries. And our latest offering, which we're very excited about, is revenue recognition for ERP, and whether companies have SAP, Oracle, or other ERP applications and find themselves using spreadsheets, our application fits into those environments and is highly configurable for different industries. It really handles revenue recognition, allocation, scheduling, forecasting, and so forth for those companies who have existing ERP systems and find a hole in that processing and are doing that manually. And we're very pleased to hear from our customers that overwhelmingly they say that our work allows them to improve the compliance with Sarbanes-Oxley or some of the revenue recognition issues that Lynne and Jacqueline will talk about today. They increase operational efficiency in all aspects of billing and revenue management and revenue reporting, and also improve their customer relationships. So our mission is to help our customers increase their revenue, reduce their operating costs, all the while complying with the regulations, many of which Lynne and Jacqueline will talk about. So let's get to our featured speakers. And Jacqueline Akerblom has nearly 25 years of experience working with principally technology companies, and both as an insurance and corporate finance partner. She serves as the co-lead of Grant Thornton's Bay Area technology industry practice, and she is one of the national directors of Grant Thornton's technology industry practice in the U.S. And as I said, Jacqueline joins us from California. And our first speaker will be Lynne Triplett, and she joins us from Chicago. And Lynne serves in the accounting principles group of Grant Thornton and has more than 20 years of experience assisting public and private companies with complex accounting, auditing, and SEC matters, including revenue recognition. And she is also one of the national directors of Grant Thornton's U.S. technology industry practice. So welcome to you both, and I think Lynne will start.
Thanks, Bob. Actually, it's Jacqueline that's starting.
Oh, after all that, I got that wrong.
Okay. Thanks a lot. Lynne and I both work extensively with our software clients here at Grant Thornton, and we developed this agenda today to highlight the recurring revenue recognition issues we see repeating in our client base. We do want to emphasize that this is a very high-level discussion of some very complex accounting guidance. We will be happy, as Bob said, to take as many questions as possible at the end of our presentation, and we'll also do our best to follow up on any unanswered questions following this webinar. Determining the right accounting literature to apply is not always as easy as it may seem. Software revenue recognition is made more complex by the fact that contract terms often differ from customer to customer, and sometimes even for the same deliverable. As a result, it's critical that there is an understanding of the terms of each arrangement. Lynne, let's talk about some of the pitfalls or warning signs we've run into with our clients in the area of revenue recognition. As I indicated on the previous slide, understanding the terms is an imperative. If your sales force has the ability to customize a contract, you can't assume similarity from contract to contract. I've certainly seen clients wide-eyed with surprise when we've brought some unusual provision buried in a contract to their attention during the audit process. And chances are that unusual provision will affect revenue recognition. Globalization adds to the complexity. If you're entering into an agreement in Japan or Germany, the customer may insist on terms which you would not ordinarily see in a U.S.-based transaction. One of my clients entered into a contract with a Japanese company. The customer on the Japanese side insisted on establishing a technology pool, and this was in addition to the usual remix pools that my client was accustomed to. This provision in the contract generated a great deal of discussion between ourselves and the client around the impact that it would have on revenue recognition.
You know, Jacqueline, it's not just the global nature of the business environment, but also here in the U.S., sometimes just the customer size impacts the contract terms. And if the customer is quite large in comparison to the size of the vendor, they sometimes have the ability to influence what is or isn't included in the contract terms, which can, in fact, impact revenue recognition.
Absolutely. Then it comes down to a business decision. If you're out there and you're a small or mid-sized enterprise and you're doing business with the largest of customers, you're probably familiar with the fact that they very often insist on utilizing their own contract formatting terms, as Lynne said, rather than what you have adopted as your standard. You want to be sure you understand all the provisions included in their format and make an informed business decision. It's so important for senior management of your company to also set the tone at the top when it comes to undocumented side agreements. There should be frequent and reoccurring discussions within your sales force emphasizing the penalties for these types of arrangements. Even in situations where there are no undocumented side agreements, the lack of communication can result in a revenue recognition result which is less than optimal. And it might have been optimized had both parties communicated before the contract was signed. I've often seen my clients bemoaning the fact that contract terms were negotiated without consideration or consultation with the finance department of the revenue recognition impact that it might have.
I think, though, just as a reminder, you know, sometimes, Jacqueline, there are business decisions that get made, and that's not always wrong for a contract term to impact revenue recognition. It's just a matter of being aware of what those terms are and what the impact is going to be. So, again, going into it with your eyes open as to what your revenue recognition implications might be as contract terms are changed.
Absolutely. At this point, I'm going to turn the presentation over to Lynne to talk about the SOP 972.
Okay, thanks, Jacqueline. Another challenge that software companies face results from the volume and complexity of the revenue recognition guidance that exists. In this quick session, we can't possibly address all of the literature, but I am going to begin with a brief discussion of the applicability of 97.2. One of the difficulties lies in determining whether or not 97.2 applies. Many people believe that the 97.2 model is more restrictive because of the need for vendor-specific objective evidence of fair value, and they don't always apply it when they should. But we've also seen recent instances of companies using 97.2 when it does not apply, particularly in software hosting arrangements, which Jacqueline's going to talk about in a few minutes. So when does 97.2 apply? Simply put, it applies when software is licensed, sold, leased, or otherwise marketed. However, it does not apply when the software is incidental to the products or services as a whole. Because so many products and services contain embedded software, it can be challenging to determine when the software is more than incidental. A company that hasn't historically thought of itself as a software company may find that it needs to apply 97.2 because its product has evolved and the software is no longer incidental to the product as a whole. Examples include companies in the medical device and telecommunications industries. It's important for companies to regularly assess whether or not 97.2 applies, especially when their products are evolving. Even though 97.2 provides indicators to assist companies in making the determination about the significance of embedded software, it's still a difficult area to apply, and significant professional judgment may be needed to determine whether the software is more than incidental. None of the indicators given in 97.2 is presumptive. Rather, they should all be considered together to determine if the software is more than incidental. In looking at the first indicator of whether the software is a significant focus of the marketing, a company should evaluate whether the software is used to differentiate its products from those of its competitors. Is the customer buying because of the product, or are the features and functionality of the software such a focus that it is likely that the software is influencing the customer's buying decision? In evaluating this factor, all of the marketing materials that are available to a customer should be considered, and those include the company's website, customer proposals and other product write-ups, and even the content of conversations between sales personnel and the customer. Selling the software separate from the product may also indicate that the software is more than incidental. And in addition, if a company provides support services for the software in the form of upgrades, enhancements, or other maintenance, including when and if available deliverables, this may indicate that the software is more than incidental. And if a company provides support for both the hardware and the software elements, it's sometimes difficult to determine the significance of the support provided for each. If the software support is limited to bug fixes and doesn't provide additional functionality, it may mean that the software is only incidental to the product or service, and 97.2 might not apply. And finally, a company should evaluate the level of software development costs in relation to the total development cost of the product. And as those software costs go up, it does become an indicator that 97.2 might apply.
If I can interrupt for 1 minute, I just want to remind our audience that they can ask questions by clicking on the Ask a Question button, and I'll be reading those throughout. And I'll ask all the questions at the end. But just to encourage people, we did have one specifically about this. And so, given these guidelines, do they make a case for 97.2? How do they work with their auditors to make a case for or not a case for 97.2?
I would recommend that they actually do go through each of these indicators to see where their company falls. Look at your marketing materials. Look at what your website says. Look at how your sales personnel talk with the customers and portray the product. Is it really the software or is it the product? So to go through each one of these, is there support provided? And just prepare a position paper and then talk with their auditors about it. We've come to the conclusion that it does or does not apply, and here's the reasons why from looking at each of these indicators. Can you agree with our conclusion?
Lynn, it's really important that companies actually think about this, especially if they aren't a traditional software enterprise. One of my clients in the recent past was a telecom company, and they considered themselves to be a telecom equipment manufacturer. And up until the point that they introduced a new product, that's basically what they were. However, as we were in the audit process and looking at this new product, we looked at these points. We looked at the very significant R&D development costs that went into the software component. We looked on the client's website and saw significant marketing material emphasizing the advantage over their competitors because of the software component of this piece of equipment. And they also did provide PCS in the arrangement. But when we raised this with the client, because they were so set in their mind that they were an equipment manufacturer, they never really considered that 97.2 might apply to them. And once we went through the process, we ended up with the conclusion that with the introduction of that new piece of equipment, that they did in fact fall into 97.2.
Yeah, and I think, I know that many people look at 97.2, as I said a little bit earlier, as the less advantageous accounting to have to apply. And so it is really important to step back and consider each of these and carefully evaluate arrangements, especially with embedded software and in companies that haven't considered themselves to be a software company, so that they can determine the appropriate accounting to apply. If a software license arrangement conveys the rights to more than one deliverable, application of the basic revenue recognition criteria of 97.2 is made more complicated because each element must be evaluated to determine if the fees can be allocated between the deliverables. And this includes post-contract customer support, or PCS. I think because so many software arrangements include multiple deliverables, companies often must apply more than one piece of accounting literature to an arrangement, and the interaction of the literature can be quite challenging. And I'm going to talk a little bit about that, but it certainly is something that increases the complexity of software arrangements and accounting for them. The first step in evaluating a multiple element arrangement is to determine what the various deliverables are, and that sounds quite simple, but it is actually something that I see quite often, that people haven't read all of the contract terms to see what exactly is being required to be delivered. And often arrangements include both software and non-software related elements. And if a multiple element arrangement includes software that is more than incidental, so now you've tripped yourself into 97.2, but you also need to look at EITF issue 035 to determine which elements are in fact within the scope of 97.2 and if there are elements outside of the scope of 97.2. And in doing so, Issue 035 requires an evaluation of whether the software is essential to the functionality of the other elements. And if the answer is yes, then the entire arrangement is within the scope of 97.2. And so the separation guidance of 97.2 is applied to determine if the elements can be treated as separate units of accounting. But if the software is not essential to the functionality of any or all of the other elements, then 97.2 is applied to the software element, or if there's more than one software element, to all of those elements. And other literature is applied to the non-software element. And the other literature should include the separation guidance of EITS issue 0021 if there's more than one non-software element in the arrangement. And then also the revenue recognition guidance of Staff Accounting Bulletin 104 would be applied. This is just one example of how the interaction of the accounting literature increases the complexity of accounting for a multiple element arrangement, and it's critical that there's an understanding of all the terms of the arrangement in order to come to the right conclusion regarding the accounting literature to apply. Many software arrangements include both software and services, and the services could include installation, training, software design, or customization and modification of the software. If the services involve significant customization or modification of the software, then contract accounting under Statement of Position 81.1 should be used for the arrangement. In these situations, the software cannot be separated from the services, so it's treated as one unit of accounting. So even if there's a non-refundable upfront payment for the software license, there isn't upfront revenue recognition in these types of arrangements. If the services don't involve significant customization or modification of the software, so if you just have implementation or training or some other type of consulting services, the company should evaluate whether the services can be separated from the software for accounting purposes. And in order to separate the services, there must be VSOE of fair value for the services. The services must not be essential to the functionality of the software or other elements in the arrangement. And the contract must describe the services in such a way that the total price of the contract would be expected to vary if those services were not included in the arrangement. And revenue recognition can be challenging in software arrangements that include service elements. If VSOE does not exist for all of the elements, then the order of delivery of those elements can impact revenue recognition. We've also seen numerous companies inappropriately using percentage of completion accounting. And percentage of completion accounting should only be applied to arrangements that are specifically within the scope of SOP 81.1 or involve significant production modification or customization of software, as SOP 97.2 then directs you back to 81.1.
Just a quick question on 81.1 that we got from actually one of our customers. What's the most common metric used? Is it milestone-based? Is it hours, weeks, months? What's the most common metric used?
I will say that the most common is generally some kind of hour-based metric. A preferable method is to look at, kind of the outputs that are given, but I think most people actually look at the hours, and whether it's hours or months, but some type of time metric.
Okay, measured up against the project.
Right. Okay. And so measuring the time that's been incurred to the total time expected.
Okay, thank you.
And converting that to cost, obviously. But revenue for services that are not within the scope of 81.1 should be recognized as the services are performed using the proportional performance method or on a straight line basis if no other pattern of performance is discernible. In some situations, I think this is what trips people up, is that the proportional performance method looks an awful lot like percentage of completion, but there are differences, and one of them is that in applying the proportional performance method, costs are expensed as incurred. They're not, captured on the balance sheet and taken in some future period. They're expensed in the period incurred. There are many other multiple element software arrangements that we could go into, but we're actually just going to focus a little bit later on software as a service, because this is a sector in the software industry that has recently experienced increased activity, and it's an area that's generated many questions that we've seen. So one of the hurdles to separating software elements within the scope of SOP 97.2 is establishing vendor-specific objective evidence of fair value for the elements. I'm going to spend a few minutes now talking about VSOE. It is a complex and could be a long discussion, but for that reason I'm going to focus on how it relates to PCS, or post-contract customer support, as it's an area that we are frequently consulted on. In deliberating 97.2, EXEC did give some discussion and some time to thinking about whether they should allow an entity to look to the sales of another entity in determining fair value for an element. But they decided that because each software product is unique, vendor-specific objective evidence of fair value would be required to separate the elements in a multiple element arrangement. So this means that a vendor must have separate sales of the element, its own separate sales to look to. And VSOE applies to all elements in a software arrangement. I've had people say that because there are other vendors that could provide the professional services or some other element of the arrangement, that they should be able to use the price charged by others as evidence of fair value. But if the entire arrangement falls within 97.2, then the criteria of 97.2, including the concept of VSOE, should be applied to all of the elements. So VSOE is the price charged when the element is sold separately by the vendor, or if the element is new and has not yet been sold separately, then VSOE can be established by management having the relevant authority, but it must be probable that the price will not change when the item is sold separately. So in order to support that assertion that it's probable that the price will not change, it should be a relatively short period of time before the separate sale occurs, and I think people often use 30 days as a rule of thumb. And that's because as the time from the date the price was established to the date the element is sold separately increases, the likelihood of a change in the price also increases. In my experience, it's rare that a vendor will be able to establish VSOE through reference to a price set by management prior to the introduction of the element to the market. I did have a company that thought they had VSOE for a new element at the end of one accounting period because their pricing committee had set a price. They had several proposals out to customers. They believed they had good response, although no one had signed up. But then in the subsequent period, the separate sales did not quickly materialize, and the company determined that VSOE never existed, and then they needed to consider restatement of their prior period financial statements. So it really turned out not to be in their favor to try to make that argument early. And a company should have sufficient separate sales of the element to provide evidence of fair value. And we often are asked what constitutes a sufficient number of transactions, and it really requires professional judgment and depends on the facts and circumstances of each situation. But certainly one or just a few would not be sufficient. And this can be an especially challenging area for newer entities that just haven't established a pattern of sales or separate sales. So as I said, PCS is an area that we're often consulted on, and demonstrating that VSOE exists can be especially challenging for companies that have more than minimal variability in their pricing of PCS. A couple of places to look for guidance on related to VSOE for PCS is paragraph 57 of Statement of Position 97.2, and there also are numerous AICPA technical practice aids that address PCS. Paragraph 57 says that the fair value of PCS should be determined by reference to the price the customer will be required to pay when PCS is sold separately, so a renewal rate. But it shouldn't be presumed that a PCS renewal rate stated within a contract represents VSOE. A company should also have evidence of separate sales or renewals that support that stated renewal rate. There are two widely accepted methods of establishing VSOE for PCS, and they are the bell-shaped curve method and the substantive renewal rate method. And the method used by an entity is really an accounting policy election that should be made and then applied consistently to all arrangements. These two methods are somewhat similar, but each has really a different focus. The bell-shaped curve approach looks at the entire population of separate sales or renewals to determine if the substantial majority of the renewals, and that's, I think, generally 80%, although it could vary, whether the substantial majority of the renewals fall within a relatively narrow range. I think a lot of people use plus or minus 15%. And when using the bell-shaped curve method, VSOE of fair value is a range. It's not really a point within the range. So if the stated PCS renewal rate in a bundled arrangement is below the range of VSOE that's been established, the amount to be deferred and recognized over the PCS term is either the midpoint of the range or the low end of the range. And again, whether a company uses the midpoint or the low end is an accounting policy election, and it should be consistently applied. So if your company chooses to use the midpoint of the range for deferring the amount related to PCS, then you should always use the midpoint. When the stated PCS renewal rate is above VSOE, then the amount to be deferred should generally be the amount stated in the arrangement terms, and this avoids early recognition of amounts that are potentially refundable, which one of the things in paragraph 14 of SOP 97.2 is that you can't, you shouldn't recognize amounts that are potentially refundable. And in applying the bell-shaped curve method, a company should perform an analysis at least once a year to confirm that the pricing for separate PCS transactions is still within that relatively narrow range. And this analysis should include all separate PCS transactions. So even those that were outliers and you had, they were either above the range, or if they were below the range and you deferred an amount up to the SOE, all of those get included. You don't get to exclude them because you consider them to be outliers. In applying the substantive renewal rate method, a vendor should evaluate whether you look at each arrangement to determine if the renewal term and the renewal rate are substantive. In looking at the renewal rate, the company should compare the stated renewal rate in the arrangement to the total initial consideration in the bundled arrangement to determine if the renewal rate is substantive. So generally, a renewal rate of less than 10% of the initial consideration is not considered substantive, but again, it's a judgment call. There may be reasons why less than 10% is okay. If there's a significant amount of hardware costs included in the arrangement, that could be a possibility, but that's why each one needs to be looked at separately. And in addition, a renewal rate that is significantly below the vendor's normal pricing practices is not considered substantive. So in using the substantive renewal rate method, a company still needs to assess whether its pricing is consistent. I think this is the most common method that's used, but it doesn't avoid needing to look at whether the pricing is consistent. The renewal term, in looking at the renewal term, it's not substantive if it's either less than 1 year or less than the initial PCS period bundled with the software sale. And in addition, the aggregate PCS renewal period must be equal to or greater than the initial PCS period. So for example, if you had an arrangement that was for a 5-year license with an initial PCS period of 3 years and 2 annual renewals, the term would not be considered substantive. And in arrangements where either the renewal rate, the term, or both are determined to be not substantive, then VSOE for that arrangement doesn't exist, and the entire consideration for both the software and the PCS should be recognized ratably over the PCS term, and that's assuming all other revenue recognition criteria are met, and PCS is the only undelivered element. Okay, so in looking at whether or not a company has maintained VSOE, they should, again, at least annually assess whether or not the actual separate transactions continue to support the amounts being used. And this assessment should be performed more frequently if there's more than minimal variability in pricing. And there are a number of changes that could impact whether VSOE still exists, and those include changes in elements that are being sold or a pricing strategy, Or if an element's no longer being sold separately, it's only being sold in bundled arrangements, or if the range of prices of separate sales is no longer sufficiently narrow, then VSOE of fair value would not exist. Again, it's important for companies to make sure that their sales personnel are aware of the importance of pricing in maintaining VSOE if that's an important thing for the company to do. Again, as we said, sometimes companies choose to alter their pricing policy for business reasons, maybe to gain acceptance of a product in the market or some other similar reason. But in making a decision to change prices or offer concessions, just so management is aware of the accounting implications.
That's right, Lynn. It is incredibly important. I've seen a client who had established VSOE within a pretty tight range over time move out of VSOE, so that the following year we were a bit concerned because we saw a loosening of the range. They still met our view of criteria of having established it. But then the following year, the pricing was all over the board. It was a business decision that they made in order to stay in the market. They lost VSOE, and at that point, your historical financials, the revenue starts to really look lumpy, and it becomes even more of a challenge, I think, to reestablish VSOE after having lost it.
Right, thanks. We frequently get questions about whether the transaction pool must be looked at in total to evaluate VSOE or whether it can be stratified. And the population can be stratified when there are significant differences in the pricing for different pools of transactions, whether that's customer size, product type, geographical location, or level of service. But bear in mind that there should be sufficient transactions within each pool need to conclude that VSOE exists. And as I noted earlier, judgment is needed to determine the number of transactions that would be considered sufficient. But one or just a few is not it. And I've had that question a number of times. How about a few? No, probably not. Okay, Jacqueline's going to spend a few minutes talking about hosting arrangements.
Thanks, Lynn. In the past 3 to 4 years, we've really seen a steady increase in the number of clients offering their software as a service and utilizing the software as a service model. Typically, what is a hosting arrangement? Typically, the software is not transferred to the customer. It resides on the vendor or third-party server, and the arrangement provides the customer access to the software for a defined period of time. The number of companies delivering software as a service is increasing, as I mentioned, and one reason we think for the increase in the changing is the changing demands of customers who want to pay only for the functionality they're using, and they're becoming also more resistant to the tradition of the payment of a large upfront license fees. These software as service models also have lower customer infrastructure and implementation costs, and it, as I said, eliminates large upfront payments in favor of a more periodic payment stream. This ratable revenue recognition is appealing to the financial markets as well for the predictability of revenue streams. And we've seen a very high level of interest on the part of investment banks and others in the financial market for this model. So how should the revenue from these types of hosting arrangements be accounted for? Well, first we need to evaluate what's being delivered. At the very basic level, these transactions include two elements, the first one being the right to the licensed software and the second being the hosting service. However, just because they are separated in the contract terms, they may not be considered separate units of accounting under the literature. Once you've established that your software is being offered under a hosting arrangement, the guidance of EITF issue 003 should be applied to evaluate whether the software element is within the scope of SOP 97.2 or if it falls under other literature for service arrangements. When we look at 003, it tells us that if the customer has a contractual right to take possession of the software without significant penalty, and it's feasible for the customer to run the software on its own hardware or the hardware of a third party, then the arrangement has a software element to it. But what does significant penalty mean? There's two distinct concepts defined in 003 with respect to significant penalty. The first one being the ability to take delivery of the software without incurring significant costs. one is the ability to use the software separately without a significant diminution in utility or value. The software does not have to be delivered in order for a software element to exist under 97.2. When a contractual right to the software exists in an arrangement, a company should consider whether economic barriers exist as well. To be significant, an economic barrier should be a disincentive to the customer. If you determine there is not a software element in the arrangement, the entire arrangement should be accounted for as a service contract using other literature, such as EITF Issue 21 and SEC Staff Accounting Bulletin 104. The most common model of hosting arrangement that we are encountering in our client base does not include a software component, and it's therefore outside the scope of SOP 97.2. When the arrangement falls outside the scope of SOP 97.2, the software and hosting services are generally treated as one unit of accounting because standalone value for the software or the license does not exist. In fact, there really is only one deliverable, the hosting service. Some companies may be waylaid into thinking that there's a software component because the contract language speaks to a separate software license and hosting piece. There may even be separate pricing within the contract. However, if you've not met the provisions of 003 discussed on the previous slide, the arrangement is really a subscription to the software product via the hosting arrangement. Since the hosting is delivered over a period of time, revenue for the arrangement is recognized ratably as the hosting service is performed over the estimated customer relationship period in accordance with SAB 104. Note that the relationship period is often different from the hosting period. The relationship period is an assessment which must be made at the inception of the contract together by the finance or accounting department with the sales or customer relationship representatives. It's a determination of whether or not there's an expectation that renewals will be entered into and or other products from the company contracted by that customer. The relationship period should also be revisited as new arrangements are entered into with the customer. So even if the contract provides for an upfront cash payment for the software license, that amount would be recognized as revenue ratably over the relationship period. There would be no upfront recognition for the software because it's not a separate deliverable. For those of you who are private companies out there, you may ask whether or not you're subject to SAB 104, which was promulgated by the SEC. Grant Thornton's position is that SAB 104 is based on GAAP, and we believe it's reasonable to apply the SEC's guidance to non-public companies as well. Hosting arrangements often include professional services or other elements in addition to the software license and the hosting. These additional services may be delivered at various points in the arrangement, and they're not always an upfront deliverable. When the hosting arrangement is outside the scope of SOP 97.2, because software is not provided, the guidance of paragraph 9 of EITF Issue 0021 should be used to evaluate the elements for separation, and the order of delivery may impact revenue recognition. Use of the residual method to allocate consideration requires that evidence of fair value for all undelivered elements exists. Note that the hosting service remains an undelivered element for the life of the contract. Sometimes it's difficult to determine standalone value in a hosting arrangement. Standalone value means that the element is sold separately by another vendor, or the customer could resell the element on a standalone basis. In performing this evaluation, an entity should consider whether the undelivered element, usually the hosting service, is required for the delivered element, for example, implementation services or professional services, to function as intended. In many situations, the vendor maintains proprietary knowledge related to the software, and as such, no other vendor could provide the professional services or the implementation. There are other situations where the proprietary knowledge may not be necessary to perform the other services, and so as long as there's another vendor that can perform the services, the first criterion of EITF 0021 may be met. 0021 also tells us that the best evidence of fair value is vendor-specific objective evidence, VSOE, as defined in SOP 97.2 and as Lynne just took us through in the previous slide. When VSOE is not available, third-party evidence may be acceptable. The best evidence of fair value is the price of a deliverable when it's regularly sold on a standalone basis. The third-party evidence should be relevant in that it is for a similar product for a similar customer. If the service is highly customized, relevant third-party evidence may not exist. This may be a pitfall in hosting service arrangements. The last element being delivered is generally the hosting services, and there generally is not another vendor that can be pointed to as providing sufficient similar hosting. When fair value for the hosting services does not exist, the arrangement must be treated as a single unit of accounting, and revenue would be recognized ratably over the customer relationship period once the hosting is the last undelivered element. Since hosting is generally the last deliverable in the arrangement, evidence of fair value for the hosting services must exist in order for the other elements in the arrangement to be separated for revenue recognition purposes. Hosting services are generally unique to the vendor, and as such, the vendor must have separate transactions to evidence fair value. Since the hosting services are rarely sold initially on a standalone basis, the best evidence of fair value is renewal rates. In order for renewal rates to provide sufficient evidence of fair value, there must be a history of separate renewals at the stated prices, and the pricing should be consistent for similar arrangements.
Jacqueline, you know, this is one of the areas that I think some people are a little bit tripped up by because since hosting is a new delivery model for so many companies, it takes a while for a company to accumulate sufficient evidence of fair value, and I know it's hard for people to understand that initially they might not have that fair value to be able to separate the elements.
That's absolutely right, Lynne. Let's walk through an example. In this situation, we have a 12-month hosting arrangement. The contract calls for professional services to be delivered over the first 3 months of that arrangement. As there's no fair value for the hosting, the revenue must be deferred until the professional services are delivered after the first 3 months. Once the only remaining deliverable is the hosting, the company then begins recognizing revenue ratably over the remaining 9 months in the relationship period. This could potentially be stretched out to a longer period if the relationship period was deemed to be longer than the initial contract period of 12 months. As I previously indicated, the guidance at 104 points us to estimating the length of the relationship period and recognizing all revenue ratably over that period. Bob, this concludes our prepared remarks, and Lynne and I will both be happy to entertain questions.
Well, I don't think I've done many of these webcasts, but I think I would be reading questions, and on the next slide you would be answering them. It was very interesting from my perspective to watch that. So either it was that as questions would come in, and I would write them down and get them ready, you turn to the next slide and you'd answer many of them. But given that we have about 100 or so, you didn't answer them all, and that would be impossible. But thank you very much, both Lynne and Jacqueline, for a great job in terms of touching on many of the topics. And one of the early topics you talked about was sales contracts, and many questions about that, of course, and how to control and motivate a sales force to standardize their support for fair value and abide by revenue recognition rules. Any thoughts just in terms of best practices that you might have seen out there in terms of your client base and in terms of how finance and sales forces have worked together well?
Well, Bob, I think that the most successful companies have a really strong dialogue between finance and accounting and sales. Things like sending finance people out to regional or national sales meetings. At least in my larger clients, they have regular sort of quarterly sales updates and meetings, and they make it a standard policy to have someone from the finance team at the meeting, networking with the sales reps, and even spending some time at the podium reminding them about the accounting revenue recognition rules as it applies to them as the customer relationship folks that are entering into the contracts.
Okay, so it's certainly certainly a challenge. One of the interesting things that we've seen in the use of our products is that they're taking quotes before they're sent to customers and routing them through our product to see the revenue impact, and it's an interesting development for us to see customers who are looking to first get revenue treatment on their contracts and different versions before they get to their customers, because they don't want to be surprised later on. And in this world of revenue recognition, surprises are not what anyone wants. I'm sorry.
Oh, I was going to say, and adding on to that, another best practice is not only the communication between accounting and the sales force, but oftentimes our clients will bring particular provisions to us as the auditors to sort of review and quote-unquote sign off on before they enter into the contract, or make sure we're all in agreement.
Okay, great. Just an absolute ton of questions on VSOE, which is no surprise to anyone. And again, as I said, it was interesting as there were questions about size of customer and geography and things like that. And then on the next slide, you went to those, which was great. But just a few questions about services. And so geographically, obviously, services rates range dramatically. So most of your customers would be able to establish a different VSOE as they function around the globe, as so many companies and so many of our customers do.
Right. I think geography is certainly one way to take the cut. And again, it's just important that there are enough similar transactions, and oftentimes services, it's a rate that people are looking at. So if you have a rate that you're selling at, and that works well, and you can take your geographies and look at each geography as a separate pool. For establishing VSOE.
There were some questions about the difference between, just for people's VSOE and fair value. Could you just either of you spend a moment on that, the difference and when one might apply versus the other?
Well, actually, 97.2 it's vendor-specific objective evidence of fair value. So it's one way to determine fair value, VSOE, and it's the one prescribed by 97.2 for software arrangements. So any software arrangement that has more than one software element, you would need to have vendor-specific objective evidence of fair value in order to separate those elements for accounting purposes. Fair value, which is looked at, I think, under 0021 is one place where when you need to separate elements that are not software related and don't fall under 97.2, then the fair value guidance of 0021 can be applied. And again, I think as Jacqueline said, VSOE is the best measure of fair value. So if you have your own separate sales of something, but if you don't, under 0021, if there is another vendor that sells a similar enough product or service, you can look to what they sell it for as evidence of fair value.
I think, at least if I look to my clients, they would consider VSOE to be the most stringent criteria to meet. And if you're a hosting arrangement that's not subject to 97.2 and VSOE, then it might be a little bit easier to get to meet the fair value criteria of 0021.
Great. A lot of questions about thresholds, because again, these are judgment calls, and just maybe back-to-back questions, and you can answer them both. What is a good threshold to use when deciding whether software development costs are significant? And if you can't answer that specifically, maybe again to all these questions, because we don't have numerical answers here, but just as it might be advice to get to that decision. And let's just start with that one first.
Well, I'd say that it really is a facts and circumstances situation. However, in the example that I gave earlier about my telecom client, we saw a noticeable difference in terms of the percentage of development costs related to the software component of that piece of equipment than when compared to the software components of previous generations of equipment. So, again, it's facts and circumstances, but when it is noticeable, when you see an evolution in your product offering such that you're spending significant dollars in the R&D mode on the software component where you haven't in the past, that's a pretty strong indicator that you've passed a significant threshold.
Okay. That's because this is what we're seeing, because telecom is a booming customer base for us right now because of the developments there, and they've now greater complexities in terms of revenue recognition that they're now subject to. Someone talked about separate contracts, and I think it might be good to make a comment on that. If hardware's on one contract, software's on another, maybe we should give some advice on whether that really matters.
Well, if hardware's on one contract and software's on another, and they're sold within a relatively short period of time of one another, some people say 6 months, you certainly should consider whether or not they are not really one arrangement as opposed to two separate arrangements. And so just papering something as hardware on one piece of paper and software on another piece of paper doesn't negate the fact that you need to look at them as one arrangement.
And certainly you folks would be looking at them potentially as one arrangement.
Right.
The whole idea of the nature of the services, you talked a lot about customizations, but many people provide services that are not customization services. We're not at the hosting discussion yet, but I'm just talking about standard issues about software that they're not customizations. They may be configuration, they may be technical services, things like that. How can we help people decide whether something is going to be influenced and really be called a customization?
I think, again, it's really looking at the effort that's being applied and what changes are being made to the software. If it's really changing the features and the functionality of the software, there's a good chance that it might fall into the significant, and then again, it needs to be significant.
You'd look to see, is the software usable in its current state, or are they making such modifications, as Lynne said, that the customer's not even using it yet?
Okay, so whether it's actually usable without this service.
Right. That's one factor you'd look to, yeah.
Okay. In terms of order of delivery, there's a few questions about that. Why or how does the order of delivery in a multi-element arrangement affect revenue recognition? And is there any kind of reference or guidance on that? The order of delivery.
Well, in looking at, especially under software arrangements, I guess you look at 97.2, and in order to separate elements, and if you have more than one, it's looking at the undelivered. You have to have vendor-specific objective evidence of the undelivered element in order to separate them and account for anything early on. Because in using the residual method, let's just say you just have two elements. One is the software license, and the second is some type of service that's going to be provided later, and neither the service nor the software is essential for the other one. You would need to have VSOE of the services in order to say then, okay, I'm going to take that amount, that fair value, and defer the consideration related to the services and use the residual method, so whatever's left you can then record for the software. So when you have more than two deliverables, you're always looking to see what's going to be the last delivered. What do I need to have VSOE for in order to be able to separate any of these elements?
And similarly, in a hosting situation, the order of delivery is important, because if you, as I said, the hosting is delivered as you provide the service. So if you refer back to the example that I walked through on my last slide, the hosting was being delivered during those first 3 months. However, there was significant professional services being delivered in those first 3 months as well. And so the order of delivery, you could not start recognizing revenue on any of the cash collected or received until those professional services have been delivered.
We always have a forward-looking question, and I think we have time for that. If you look in your crystal ball, what does the FASB or any other standard-setting body have for projects on the horizon that might change and or simplify? I think they're hoping for that. Any of the rules related to software rev rec?
Well, I think there's, as many people might be aware, there's a significant project undertaken by the FASB to kind of overhaul revenue recognition in total, although that's a long-term project. I don't see anything on the short-term horizon that is going to significantly impact software revenue recognition, and I would hope that this overhaul would, in fact, simplify the accounting, but sometimes things don't work out that way.
Well, you're not the only one who would think that. I'm sure that's on the call. Lynne, Jacqueline, thank you very much for your time today, your preparation, your insight into all this. I know I found it very worthwhile, and I'm sure that everyone in the audience did as well. And I want to thank our audience for their participation. Many, many questions, and I'm sorry we couldn't get to them all. And please do remember that as you look now at the screen, that you can your browser will be directed right now to an online survey. We listen to those very carefully. From there, if you haven't gotten them already, you'll be allowed to download the slides, and people have certainly been asking for those. And there's also a follow-up email with a link to an on-demand recording of this webcast. So please do that, and that's very valuable for us. And please continue to visit our sites at revenuerecognition.com, softrax.com for upcoming Softrax